All right. Well, it is now 2 o'clock Pacific time, so we're ready to start this thing. Good afternoon, everyone, and welcome. I'm Brent Mekosh, co-founder and managing partner here at the Wealth Stewards. Today's conversation is a very important one because we're sitting right at the intersection of real estate, tax planning, estate planning, and also portfolio strategy. We're going to discuss 1031 exchanges, Delaware Statutory Trusts, also known as DSTs, and 721 UPREIT structures. If this sounds a little complicated, it's because it is. But I'm very fortunate today. We are very fortunate because we're joined by three really outstanding professionals from the Forum Investment Group. We have Ryan Brome, Chief Operating Officer. We have Grant Turner, Managing Director and Client Portfolio Manager. And we have Ben Lowe, Managing Director. Gentlemen, I really want to thank you for being here. Before we jump into this, I want to frame why this matters. If you're a real estate investor, one of the most expensive mistakes that you can make is selling a highly appreciated or low basis property before really understanding what your options are ahead of time. A direct sale is very easy, but it can also trigger significant capital gains. In some cases, that means losing 20 or even 25% or more of your gain before you have even a chance to redeploy this capital. A key phrase I really hope everyone takes away from today is to plan ahead. All the strategies we're going to discuss have timing rules, they have tax rules, they have structural requirements. And once a sale closes, many of these options may also disappear. So today's purely educational. My goal here today is not to give you tax advice, legal advice, or investment advice. The goal is really simple. It's to help you understand what your options are before you're forced to make a decision, especially if that decision, quite frankly, is under pressure. And with that, let's get started. First, I'd really like you all to introduce yourself, tell us a little bit about Forum and why you're joining us on this webinar today. Ben, you want to start with it?
Yeah, why don't I kick it off? I appreciate you having us, Brent, and welcome everyone. My name is Ben Lowe. I'm Managing Director with Forum Investment Group. Forum is a real estate and investment management firm that started nearly 20 years ago. We're based up here in Denver, Colorado, specifically in Cherry Creek. We are, as I mentioned, a real estate and investment management firm that I would qualify as a specialist in the multifamily category of commercial real estate. So, what Forum does, we are a developer, we are an acquirer and operator, and we are also a direct lender. All in the multifamily area of commercial real estate. We've deployed over the last, nearly 20 years, about $6.5 billion up and down those opportunity sets in the capital stack of multifamily real estate. So we are excited to be here. My role specifically within the organization is I really work as kind of a relationship liaison with Forum's investment management group and wealth management firms like the Wealth Stewards in the Rocky Mountain State. So I work with wealth managers to educate on Forum and the private market, specifically the real estate market. So that's what I do. Looking forward to the conversation today. Ryan, I'll turn it over to you real quick.
Yeah, great. Thanks, Ben. And yeah, Brent, appreciate you guys having us on. Ryan Brome, COO Investments. So I've been with the firm about 10 years. I sit across kind of our various investment verticals. So we've got 22 investment professionals here that allocate kind of on behalf of our debt as well as our equity strategies. Today, we're going to specifically focus on kind of our equity strategy and our kind of 1031 DST program. But as Ben mentioned, we predominantly kind of focus on the private wealth space. So we really, are working with kind of RIAs all across the country to kind of invest, in our various solutions. So look forward to talking about this. I think it's timely. We definitely see kind of a demand and a need for it, kind of within the private wealth community. So with that being said, I'll turn it over to Grant. He leads our exchange platform, and he's going to kind of run us through sort of some of the basics of 1031 exchanges and the Forum program.
Absolutely. Thanks, Ryan. Yeah, as Ryan noted, right, I'm the head of the exchange program over here. Previous to this, I spent about 8 years over at Ares Wealth Management and helped build basically the largest 1031 program in the industry, where they were doing about $1 billion a year. So a lot of experience in the space, bringing that over to Forum to help build the program here.
One thing I'd like to add just really quick about Forum that I think is wonderful about you guys is so many of these companies that are involved in private markets. They're great shops, but they're farming out a lot of the individual processes to other teams. You guys are doing this all in-house, which I think is pretty important to our discussion today.
Yep, absolutely.
So with that, let's start talking about the key concepts of these tax deferred exchanges. I think the first one we're probably going to discuss today is one that most people are familiar with, and that is the 1031 exchange. So do you guys want to walk us through what that is and how that can apply to some of our listeners?
Yeah, absolutely. So in essence, a 1031 exchange is going to be an exchange of real property, right? So a client can sell a piece of rental property, for instance, right? They can have those monies go to a qualified intermediary, and they're going to have 45 days to identify their place of properties and 180 days to complete that exchange. So the nice thing is it's a very broad category of like kind. So as long as the investment or the property is held for investment purposes or business use, it is like kind to other investment or business use properties. So a rental can go to an industrial warehouse can go to a shopping mall can go to a multifamily apartment. Now, that qualified intermediary is going to be necessary with any 1031, including programs like ours. They're basically going to be a subsidiary of a title company and hold those funds on the client's behalf so they don't have constructive receipt. They're also going to work with the title company on the buy side and get that money transferred over to finish that purchase.
Now
You
let's
know,
talk.
Grant, one thing I would just mention here is that, I think a lot of folks are familiar with what a 1031 exchange is. They've actually been
Mhm.
around for probably going back 40 plus years, exists in kind of the tax code for the IRS. But where sort of these programs have really evolved over the years is traditionally a 1031 exchange was you sold an investment property and you went into another property. And that's what most people are kind of
Mhm.
familiar with sort of in these programs. And so as we kind of dive into this, we're going to go maybe a little further into how it's evolved and where, we've
Mhm.
seen the industry kind of get, much more institutional in terms of quality. You're not going from one asset into another asset. And that's, I
Mhm.
think that's what we'll kind of dive into as we move forward.
Yeah, that's right. Yeah. And the nice thing is it's not all or nothing, right? You can still buy a rental home or, an investment property and then also do a program like this where, as Ryan noted, you're not having to deal with that management. You're getting far more diversification.
One thing with 1031s, though, I want to point out is that we've got some deadlines here that you have to work around
Mhm.
doing these. So
That's right.
you want to dive into those a little bit and how some investors might get tripped up on that.
Yep. Yeah, absolutely. So, that qualified intermediary has to be set up before the close of the property, right? So up until you sign that paperwork, you still have an opportunity to get that qualified intermediary that will be necessary to defer taxes. Once the property is closed and the money hits that qualified intermediary, you have 45 days to identify a property. What that means is choose a building or a program you'd like to invest in and identify on the qualified intermediary paperwork the address of that property and either the percentage of the building you're going to purchase or the dollar amount that's being invested. Um, you know, for other programs, right? Maybe those direct purchases, there is about 135 days to purchase what you identified in those 45 days. So 6 months in total from the sale of the property. With this program, we're going to get it closed, pretty much as quick as possible. But the reason there's that large time frame is deals fall through, right? Things change. Maybe the inspection didn't go well. It can take longer period of time for a direct purchase, and so they give you a little more time to complete that transaction.
And I think that's really critical because if you're doing the 1031, it's a really effective strategy that people have used for years and years and years very successfully. But to your point, one of those timing issues gets choked up for some reason. You could go from thinking you're deferring all the tax on your gain to suddenly having a very large tax bill at the tail end of that.
That's right. They're hard and fast deadlines. So if one is missed, taxes are due. And so, in the past, right, for these types of programs, people are using a tenants in common. So everybody was going to be on title, owning their percentage on title, right? Or, traditional 1031, you're going to have to be on title for the whole amount. What happened about 20 years or about 14 years ago now, is Delaware Statutory Trusts came about. It's really just another structure. And as you can see there on the right with the pie chart, another structure to get a whole bunch of investors into one piece of property. The big advantage versus a tenants in common is the sponsor, or in this case, Forum, is still dealing with all the day to day. We're still dealing with the taxes. We're still dealing with the tenants. We're doing everything for you. And in the event somebody were to slip or fall and sue the apartment complex, you are protected, right? The DST protects you from all liability, and the REIT, which we'll go into a little bit longer farther down, is actually the tenant and takes all that risk and responsibility.
And so again, a real world scenario would be here that you don't have the target property in place, and these DSTs Forum, of course, is one provider, but there tend to
Mhm.
be multiple different options that are out there. You're giving up that very active management and ownership of that property for something much more passive, but along with that, all that liability transfers as well.
Mhm. Yep. Yeah, and a larger property that you could probably, purchase yourself. So, you get some scale, probably a market that you may or may not have been looking at. So it helps create more, diversification. If you're already a large real estate investor, now you get a bigger property in a different market.
And give us an idea in terms of availability of DSTs, because I do understand that, at least from the forum perspective and some of the other providers, these are not always all available all the time. So
Mhm.
it tends to sort of be rotating in and out of availability. Is that accurate to say that?
Yeah, somewhat. Yeah. So the idea is, and the perfect program is going to have a rotating property to invest in, right? So right now our property is about 44 million in size. We've got about 37 million left. When that gets close to selling out, we're going to get another one ready and have that popped up. So ideally, there's not a big kind of pause between these offerings, but that can happen, especially with those larger sponsors that have much larger properties, in excess of $400 million for their investment. There can be a larger pause between those. So, as Brent noted, timing is really important with these types of investments, right? You should be looking around and figuring out, or at least narrowing down, what you might want to do if you do sell that property and what's available at that time.
And Grant, also for my benefit, DST is always going to be attached to a single piece of real estate. Is that correct?
It can be multiple properties. Yeah. So those larger ones, if you go out there and look at, the Aries, the JLL, the Hines, the really big guys in the space, they're going to be building, DSTs in the space of 200 to 400 million in size, which can take a lot longer to close. You do get more diversification, but you don't get kind of that laser focused value, which Forum is known for.
Okay. All right, one more question for you guys before we move
Yeah.
on. So I'm looking at the slide. I'm seeing a reference to seven deadly sins.
Yeah.
Can't not ask you what the seven deadly sins are in this case.
Yeah, so basically, those are the rules that the DSC has to follow in order to be a tax deferred vehicle to work as a 1031. One of the big ones, for instance, is the DSC cannot engage in leasing activities, right? And so, in a lot of these DSTs, what they do is they have one property with one tenant, and they let it go for about 7 years, and after that time, they sell it, right? Because they can't get a new tenant in there. They don't want to pay that balloon payment if there were a mortgage. So we kind of alleviate that with putting the REIT as the tenant. So the REITs can then go in and basically subtenant and rotate through. There's a bunch of things like that. Basically, the tax and legal opinion that each one of these programs gets says we are following the rules and we're avoiding those sins.
Got it. Now, also, is there a required holding period for DST?
Um, Ours and generally this type of program, which goes into a larger fund down the road, is going to have a minimum of 2 years in the DST, and then generally it's going to be a 1 year period after that for the buyback, which we'll get into a little bit later.
Great. Thank you.
And the 721 is kind of the new thing added to these 1031 programs, say maybe 10, 15 years ago, right? It is relatively new in the space, broadly available. So it's also called a partnership contribution or an UPREIT transaction. So traditionally, REITs use this part of the tax code to buy properties directly from investors that they wanted to have in the REIT, right? So instead of buying it for cash, they could simply give the seller shares of the REIT, right? So they would get the ownership in exchange for having the REIT added or the property added to the REIT. Now, this got added with 1031 to create a longer step process for clients that don't have properties the REIT wants to own. So instead of having, $100 million apartment building that we want to buy, well, do we just pull that right into the REIT with this? Defers all the taxes. But most investors don't own something that we want to own in the REIT, right? So let me be a single family rental. This gives somebody with a single family rental the ability to sell that 1031 into the DST, and then the REIT will do a 721 of that property into the REIT. And then each investor gets shares of that larger portfolio. So this allows, with a little bit, 2 to 3 year time frame, somebody with a single family home to get the same advantages of somebody who would be selling, a commercial property.
Now, a question for you here. So you've got, let's say you own a commercial office building and you've got five partners in this thing and you have
Yep.
$15 million of appreciation in this thing you're going to sell if we're to unload this building. You identify a DST. Does every one of the partners have to agree to that, or can you break it down by ownership?
Yeah, it depends how it's structured. Generally, if it's an LLC or a partnership where the property is owned by that larger entity, the entity is going to be the investor.
Okay.
But with proper planning, you can split it up. right, have each investor own their portion through their own name or an LLC, partnership, trust, etc. Right? Whoever's selling the property on title is who has to exchange.
Got it. So if you knew this ahead of time, you have five
Mhm.
partners. Two of them just want their money and they want to get out. They're done with real estate. Three of them want
Yeah,
to defer these taxes. You could get with legal counsel, obviously, and your tax guys ahead of time. But you could structure this in a way where you could take a single property, shoot that into a DST, and then move it up via
that's
720.
right. Yeah, the two people that didn't want to do the exchange, you drop them out of the LLC, so they have their 20% ownership directly on title, and then the other three partners are going to owning that 60%, going to stay in that LLC to maintain or partnership to maintain that whole period. They're going to be able to do that exchange. The other two get their cash at closing, and they can go pay taxes.
And the benefit of the 721 is a greater diversification. What are the other benefits away from being stuck in the DST structure?
Yeah, divisibility is a huge one, right? So whether that's tax planning or estate planning, have easily divisible shares to either sell a little bit at a time, spread those taxes over a number of years, or easily divisible shares for heirs, right? Instead of leaving them, an office building that they're
Right.
going to fight over, now they each get a portion of those shares and that investment, and they get to make their own choice. And it does receive a step up in basis on death as well.
Perfect.
Brent, I'd like to add one thing here when discussing, what is a 721, what's the benefits of it. I want to make sure everybody in the audience understands what exactly is transpiring here. I get a question, probably the most frequently asked question I get from a seller of real estate, when they understand the benefit of a 1031 from a tax deferred perspective. I get the question all the time. Ben, I'm selling my industrial warehouse, my rental property. Am I allowed via the 1031 code to exchange or any other REIT directly? And unfortunately, the answer to that is just very simply no. The IRS, going back to what we talked about previously, does not consider that exchange into a REIT as a like for like transaction. So all's we're doing here is creating a two-step transaction that allows somebody to purchase a replacement property from their sold property into a REIT. The first step of that transaction is simply to execute a 1031 into a DST, that is a single property in our case. And then after a 2 to 3 year window, we will contribute that property up into a more diversified REIT for some of the benefits that you and Grant just talked about. On a continued tax deferred basis. And now you have all sorts of diversification, liquidity, estate planning, and tax planning flexibility through that transaction rather than owning a piece of real estate directly that lacks some of that flexibility.
And is it basically, Ben, to get some clarity on that, is it because again, you've got, again, using the commercial office building analogy here, but you've got this single building you want to sell. The REIT doesn't want it, so you can't sell it and take those proceeds go directly up into the broader REIT. But the DST, you're allowed to do that. You take those
Mhm.
proceeds, purchase the shares, and the REIT does want the DST shares.
Mhm.
And and
Sure.
all and all and all of these strategies, I would again just to clarify that they're independent of whoever the buyer of your property is. Is that accurate?
Correct. That's
Correct.
right.
Correct. Yeah, that's exactly right.
Awesome. And so now we get to the REIT, right? So that larger fund that's going to be, buying the DST down in the future and your long-term investment. So really what a REIT is, you can think of it kind of like a mutual fund in a lot of ways. Instead of owning companies though, it owns properties, right? So we're taking a bunch of properties, putting it into one management structure. It does get special tax treatment, but has a lot of criteria that it has to meet. This is going to be basically that large investment fund is going to be your tenant for the first few years and guaranteeing that income. And then long term, that larger diversified fund is going to be your home until you either decide to sell shares and pay taxes or leave it to your heirs with that step up.
Okay.
And there's a couple different types of REITs, right? You're probably familiar with the public REITs. So the public REITs are a public company on the stock exchange, doing this kind of same thing, right? They're owning companies, they're pumping out income, and they're pumping out returns. They can, in theory, do 721s, but they're really focused more of the business aspect of real estate ownership and less on, these sorts of strategies to help other investors. They're worried about, performing themselves. So an NAV REIT or a net asset value REIT is going to be a REIT that generally values on a monthly basis through real estate valuations, right? Versus a public company that's going to be part of it, but they're also going to be looking through the company itself and all those things. So there's going to be an externally advised. So that means that it's going to be advised outside of the REIT itself, right? So Forum is advising the REIT on how to do their investments and helping them, what property to buy and running the show there.
Now, question for you there, Grant. As opposed to the obvious liquidity advantage you have with a publicly traded REIT, is there any other advantages to the publicly traded side versus the NAV side?
I mean, I guess an advantage and a disadvantage would be pricing, right? A publicly
Right.
traded REIT could be priced above or below their actual value based on people buying and trading the stock. An NAV REIT, like the one we have here, is going to be valued on the true value of that real estate from a third-party appraiser. So this is going to be less volatile.
And a publicly traded REIT, are they? I'm imagining they've got cash requirements. Well, no, they wouldn't have cash. I'm wondering if are they required to hold any excess? I mean, it's closed end, so they probably don't. But are they required to hold any excess cash that you wouldn't on the private side?
A lot of the rules are kind of the same, but we do have some of those private rules as far as, investors, right? And how often we have to do financials. So for the most part, they have a lot in common. The public's going to be more liquid and more volatile and have probably more overhead, right? It's a whole company underneath that, building that one REIT. That REIT is a company, right? These NAV REITs, right? These smaller private REITs are much more focused on delivering returns for investors, right? Because we're not focused on, if what's said in the news nearly as much, because something in the news about Forum wouldn't affect the price of this fund, but something in the news for real estate would, right? Both of those would affect a public stock.
Now, NAV, who's determining that valuation?
Yeah, so we use a third party called Altus, who's going to be doing the valuations in all these properties. On the public side, Altus probably does a lot of those as well, but they have more options there as well. Some companies even do it internally. So third party appraisal is a big one, and something we really kind of hold to as our gold standard, right? We want to make sure that this is a true valuation, and there's nobody here, cooking the books.
So there's no conflict of interest rules about doing the NAV, they're doing the net asset valuation yourself internally.
Nope. Yeah, you can do it all internally, and it even varies. Even if you do that third party, right? We take that third party valuation. That's what we use. Other companies are going to supply a third party valuation to get the numbers checked, and all sorts of in between there, right? So even though most companies are going to be using a third party, there's not really a rule as to where that number comes from, or even if it has to be 100% correct or just feasible.
Okay.
And so a couple common features, right? Perpetual offering. So a lot of these NAV style REITs are different from the old private REITs. The old private REITs are building up to a certain value, then they're going to sell it off and have a liquidity event for all the investors, right? So usually a big bump in value at the end because they find a buyer and somebody's willing to pay more than par for various reasons. There's also going to be different share classes, right? So instead of just being one publicly available share, we're going to have share classes with different fee structures, right? All the way from the high on those small independent broker dealers, those wirehouse guys that are going to be somewhere in between, and somebody like Brent, who's going to have the lowest potential fees on a program like this. Also, instead of having that liquidity through the market, we have a redemption program, right? So instead of going on, your E-Trade and going and selling it, you'll instead talk to Brent and he can work with us to sell shares directly back to the REIT. You're going to sell them at that current value at the time, but we do have limits so that we don't have to go sell a building to get that liquidity. So generally 2% of any month of the NAV, so the value of the fund, 5% a quarter for 20% a year is available for redemptions.
In terms of your product, the liquidity evergreen fund. So the manager also has discretion to close those gates if they want to.
In theory, yes, yeah. And the reason we have those limits and those gates is, again, we don't want to sell a building, but we also don't want to sell in cash, right? Cash isn't making anybody money. We want to go get that invested or pay down debt.
I think that's an important broader discussion to have because there's obviously been this explosion in different private market vehicles and a lot of these things can be purchased in many ways pretty easily, but knowing what the liquidity looks like on the back end is important. And to your point, Grant, I think that the lack of liquidity in the right situation sometimes can be a feature and not the bug because you're not forcing the manager to do something just based on what day-to-day investor demand might be.
That's right. A couple more options is DRIP or dividend reinvestment plan. So as those distributions are made for income, investors can reinvest that right back into the fund, right? So they can kind of create a larger investment over time if they don't need that income. Tax reporting on these private REITs is a 1099. Now, this program specifically that you get to that REIT through a 1031, it will be a K1. Then we've got some fee structure stuff there, pretty standard in the industry. Again, it's going to be kind of dependent on who you work with. With Brent, you're going to be on the lower range of all these fees. Now, what is an UPREIT? And this is where we get to 721. A 721 and UPREIT are synonymous terms.
And can I add
Basically,
one thought in there real quick, Grant, just to keep everybody with us here. So sort of outline what all this is, and now the goal is to let you give a picture of how this all works together. So there can be the clean 1031, then we can use the DST, then we can maybe do the 721. We could potentially then uprate it into a larger fund. And now we're going to try to put a framework around how these different tools and different definitions can be put together.
yep, yeah. And so UPREIT and 721 are sometimes used synonymously, but an UPREIT is actually part of the REIT itself. It's the umbrella partnership inside that trust, right? And so when we're doing that 721 or that UPREIT transaction, you're really getting into the partnership or the operating partnership of the fund, right? Which is, as you can see there on the right, part of that ownership structure. The operating partnership is really where, in most cases, the real estate lives. It's a lot simpler than doing your normal tick, right, and then finding somebody to buy it. It has a lot of advantages of the REIT, but all the tax deferred advantages as well of the 1031. And now we're going to get to, as Brent said, we're putting it all together, right? So here is a diagram of exactly kind of what happens. We're going to take your property, set up that qualified intermediary, sell the property, and then exchange into a fractional interest of our property inside that Delaware Statutory Trust. You're going to wait about 2 to 3 years, and then you have a potential 721. Now, the reason we use the word potential is through the IRS regulations. If you were to hold a property for resale, or you were holding a property as part of a step transaction, right, a series of transactions to basically go to a sale, it does void that 1031. So there has to be a risk that we don't buy these properties back. But that is certainly the plan. If we didn't buy these properties back, that we'd have some issues with our investors, our advisors, and certainly probably inside the company as well. So game plan, we're always going to buy these back as best we can. But we can't guarantee 100% that we're going to buy every single one of them back or the exact time frame to do so.
Now, Grant,
After we do,
sorry, go ahead.
no, I was going to say after we do that, then you're inside that operating partnership there on the right.
Now, what would happen if the property tied to or properties tied to the DST get sold?
Sold, yeah. So realistically, you just get to do another 1031, right? So our worst case scenario is you get to do a 1031 in 2 to 3 years, and you got a pretty good income stream right around 5% in the meantime. Our best case scenario, you get into that REIT and you have a long-term investment in a large multifamily fund.
Got it.
That makes sense?
Yeah, or I mean, do you have the option? So could you then 1031 in another DST or you 1031?
Correct.
Yeah.
Yep. So we sell the property, you can then do another 1031 into another DST. You can go back into real property, directly, or you can get cash and pay taxes, right? So kind of the same options you have when you sell your property, you've had at that time, but you got about 5% income in the meantime.
Frank, can you talk real quick about during that process of the, upreit of the DST into the larger REIT, is there a valuation of that property done? So if there's a change in value relative to the initial DST's purchase price, could that potentially benefit the investor as well?
Yeah, that's a great question. Yep. So throughout the program, and then at the time of that purchase back or that upreit transaction, we are going to be revaluing the property, right? So you will get potentially modest appreciation. And the reason it's going to be modest is because we're guaranteeing the income for those first 2 to 3 years. And we guarantee it through a master lease where the REIT is actually the tenant. And they have a set distribution they have to pay out contractually. That's why we use that word guarantee. At the end of that 2 to 3 years, when we're looking to do that 721 or that UPREIT, we're going to do a valuation, and that's going to be the price that we buy it back at. With that valuation, we're only going to use the years of that guaranteed income. So outside of black swan events that change real estate metrics nationwide, right, those valuation metrics, it's going to be very stable to get up into that larger fund.
Gotcha. And just to reiterate, the cash flow then that the DST is generating to investors after their exchange, that's starting to pay out immediately. That's monthly. In the case of Forum's offering, it's a little bit north of 5% right now. And that is what you would say contractually guaranteed via that master lease.
That's right. Yep, that 5% is guaranteed to be paid out annualized, of course, on a monthly basis, right?
Okay, great.
And so, yeah, the REIT's on the hook for, gets the both benefit and risk of those tenants underneath it.
Okay.
Hey, Grant, what's the tax treatment of that 5%?
Yeah, so it's going to be just basically rental income, right? So the clients will get to continue to claim their depreciation, but they're going to have rental income. So on the tax forms and everything, we're going to give you the information that the CPA would need to take their old depreciation schedule and swap in this new property to continue that schedule.
Got it.
Now, the advantages of this type of program over your traditional 1031, which would be, one property that either you own and hold, or one property with a program or a company like Forum, but doing it very differently, holding for about 7 years and then selling it. Generally, these are one property or just a couple. So we're giving you diversification across a larger portfolio. We're going to give you access to liquidity in part or whole after about 3 to 4 years. And we're going to give you estate planning and tax planning opportunities by that divisibility of the shares, right? You're going to have pieces you can sell off or pieces you can send on to that next generation. It also ends that kind of swap till you drop. You no longer have to find another property in 1031 because this is your kind of home till you decide to pay taxes or leave it to the kids. And once we're in the 721 program, even if they eliminate 1031, or even once you're in the 1031, once you've done that exchange, you're protected from any future 1031 changes. And that is on the chopping block just about every year. But as we know, everybody in politics also likes to own real estate because it's a great investment. So we doubt this is going to change, but our program does protect from that once you're invested.
Great. So, in this question, I guess I'm going to pose it to all of you. Give me some examples, some real world examples where you've seen a client or a property owner move through this entire process, 1031 to the DST to 721 to the UPREIT. Do you have a few examples of where that could apply or where you've seen it?
Yeah. Yeah, absolutely. So I've seen, of course, your single family rentals, right? That's just one somebody's had for years because they had that additional income. Maybe it was their primary residence 20 years ago and they moved on up. We see that one all the time. We see the people who have a small kind of portfolio of rental properties or retail properties, right? Collecting income and or looking for that appreciation over time. And in my former life, right, we saw a lot of different scenarios. Something like car dealerships up in the Northwest did about 20 to 30 million in different car dealerships as the owners were retiring because the kids didn't want to take it over, right? We've seen things like dentists, right? The kid doesn't want to take it over. He's got a business partner. Over time, this can help you break up that investment apart from those business partners. Kind of like that scenario we talked about earlier, right? Where there's multiple partners. Let's say they both do want to do a 1031, but they don't want to be stuck together forever. Once they're in the REITs, that larger portfolio, they can then dissolve that partnership and distribute out the shares to each of them and kind of go their own way. So there's a lot of scenarios, even things you might not think of, royalties on oil, minerals, water rights, air rights, pretty much anything that counts as real property that you have a title for can work for this 1031 program.
And what are we talking about in terms of values? I mean, could you listen, folks might
Sure.
listen to this and say, all right, I got to have a $50 million piece of property.
Yeah.
Like, give me
Yeah.
an idea.
Our minimum is going to be $250,000. Industry wide, the average for investments like this is about 1.5 million, right? So we're going to see anything from that 250 up to who knows what our largest is going to be, but the average is going to be kind of that 250, probably to 2 million is the range we're going to see most of those tickets.
Any investor requirement, credit investor, qualified purchase?
Just a credit investor, so million net worth.
Got it. Okay. Well, I think that's one of the things that's very interesting with this is because obviously watching you all go through this and Grant, you take us through this process, there's a lot of moving parts. And the initial reaction can be like, well, wait a second, I don't own a $20 million warehouse somewhere. This doesn't apply to me. But it does apply to somebody, again, single family house they've been renting out for years, or they own their commercial office building and they're sold a business, or there's a lot of applications here where you've got an enormous amount of equity and realized gain that's tied up in these real estates where you get tired of managing it yourself. You don't want to deal with it. The kids don't want to deal with it. You want to get some diversification away from the risk of owning a single property. I mean, I think the use cases for this process here are almost as diverse as real estate in this country, which is pretty incredible.
Great.
Any
And that's generally, Brent, when we get brought into cases to talk through this process with investors, we end up, coming up with, we hear a multitude of different reasons for why they want to sell real estate, but it ultimately boils down to, really wanting to get more hands off. But I should point out, one of the benefits we listed on there was not having to continuously do 1031s. There have been cases where we've come into where the investor doesn't want to give up that right? And they want to, hand select an individual property or a DST structure that's not a 721, because their thought process is, well, I get 5, 7, 10 years down the road, I may want to own property again. So this isn't right for everybody, but generally speaking, the people who end up navigating towards this are folks that want to continue to benefit from the cash flow that real estate can afford them in a more hands-off of a capacity. And then ultimately, our structure gives them better diversification. And then those liquidity and estate planning and tax planning sort of flexibilities that a traditional DST or traditional piece of real estate doesn't afford.
Yeah, Ben, I think you bring up a great point there. For someone that wants to maintain control of managing this property, this is absolutely the wrong thing to do.
Correct.
Because
Correct.
Yeah.
you're giving up that control for someone that might want to
Mhm.
simplify it in their life and maybe, realize that it no longer has use for the property or wants, to your point, have it divisible amongst multiple areas, and then it's a home run. I'm going to open it up to questions right now if anyone has one. We do have one that has popped in here, so I'll put it to the panel. How early should someone begin planning to do something like this?
Um,
I'd say,
Go ahead. Go ahead, Grant.
yeah, no, yeah, I'd say as soon as you start considering selling the property, you should start considering what your options might be, right? Even if this isn't 100% what you want to do, if it's something you want to consider or kind of investigate, in addition to maybe direct property, or even if you have a direct property in mind, what happens if it falls through? So I'd say right when you're looking at, hey, I want to sell this property, what do I want to do with it? In addition to whatever else you want to do, I'd say look at different types of investments and programs that aren't going to be as tied to a single building that you're going to own fully and on title, because things happen through the sales process all the time, right? Something comes in the inspection, you have to back out. The seller drops out for whatever reason, right? So I'd say when you're considering selling, start investigating this program and others, right? But we really want to be included when you start getting close to that close date or you're under contract, so we can make sure that we have capacity and also make sure to go through the program and answer questions you have on whatever particular property we have available at the time.
And I would add into that question, just from a little bit different of a perspective. Agreed that when you're trying to decide on a tax planning and investment management decision on what to do with that asset, that's a great time to talk to Brent and the team at the Well Stewards and your financial team. The other component of that is if and when you've decided that the 1031 exchange is the right course of action, to engage we briefly discussed this at the beginning, but to get involved with the qualified intermediary, the QI. I've seen some cases actually blow up in front of investors because they sold the property and they took receipt of the capital. The cash was actually, deposited into their personal account, and
Mm-hmm.
that immediately triggers a taxable event. There's nothing that can be done at that point. On the flip side, I've also been called by financial advisors whose clients have sold real estate literally the day of closing, maybe a couple hours before closing, and they said, "Hey Ben, we want to do a 1031. Can you introduce us to a QI?" Literally the day of closing, and that's a call a QI doesn't really want to get, but they will help facilitate that transaction. But I would say once you've decided you want to do a 1031 and you either have or you're getting ready to list the property, to engage a qualified intermediary at that point to make sure you're setting everything up properly.
Yeah,
And
as been noted, they can do it the day of if really necessary. Minimum, I'd say 2 weeks before closing, but sooner is always better.
we
Yeah.
definitely don't want to do it the day of, guys.
That was a fire drill.
I
I've
can do
It's
never
that.
seen
possible,
one.
but it's not fun.
No, nobody wants to do that. But you bring up a great point that I almost think deserves repeating, Ben, is you cannot take, if I'm using the verbiage here correctly, you can't take constructive receipt of that money,
Mhm.
because
Correct.
then any opportunity to defer these taxes and it goes away at that point.
Correct. As soon as you've taken receipt of the cash, even for a second, it's a fully taxable transaction.
Great, great.
Yeah. It's possible to back it out, but nobody's ever going to be able to do it because you have to basically redo the entire transaction. No bank's going to allow that to happen.
Got it. Another question just popped in here. So, first of all, how many DSTs are out there, and what should an investor ask about selecting a DST?
Dozens. There's dozens of DSTs, right? So I'd say, work with Brent, right? I'm your financial advisor because he's going to have access to be able to kind of dial down based on what you're looking for, which DSTs might work, right? We're going to be multifamily. There's others out there that are industrial. Others are just across the board, just diversified. But then there's also going to be those single asset ones, right? You could do it into a stop and shop facility. You could do it into a 7-Eleven. Those are options too, but they're all very different investments. So there's dozens out there. So Brent can help you kind of figure out what's the risk profile and what's the end game of these deals, right? Because they do vary widely.
Okay. I know we'll take one more question here, and then I really want to encourage anyone, if they have additional follow-up questions, please feel free to email myself, contact me, or anyone else here at the Well Stewards, and we can get some answers for you. This one is what I think, Ben, you might have answered this unless there's a bigger mistake. It says, what is the biggest mistake people make before selling an appreciated property? I think the construction receipt's a pretty big one, but what else
Yeah.
would you add to that?
Yeah, I think constructive reuse is the big one, has been noted. The other one would be not understanding what you have to replace, right? So a big one would be a mortgage, right? If you sell $1 million property with a $200,000 mortgage, 800,000 goes to that qualified intermediate rate closing. If you go buy $800,000 in property, you still owe taxes on that 200. So you either have to pay partial taxes, find a program that has debt built in, or add cash to replace that value. So even if you're going to pay those taxes, knowing that you're going to pay those taxes and it not being a surprise, kind of alleviates a lot of stress.
That's a great point. Well, I want to thank you all for taking time out of your day to have this discussion with us. Any final closing thoughts before we wrap this up?
Yeah, I mean, please consider the 1031 exchange as a means of tax deferral. I mean, we've run a bunch of analysis, and the average taxpayer out there, if they're selling, quote, investment property, is going to end up paying in combination of capital gains, recapture, state taxes. Are going to, pay on average close to 40% of the delta between their sale price and their cost basis in taxes. So consider the 1031 if you're looking to redeploy the maximum amount of the sales price of your sold property.
That's a great point. Grant?
Yeah, I'd say that's really great. Again, lean on Brent. He does have the access to not just us, other sponsors as well, and we're always here to help. So even if you're just high level starting to consider, we're more than happy to hop on, walk through your scenario, and if we're not the right choice, we'll tell you what out there might be good to look at.
Ryan, anything you'd like to add?
Yeah, I mean, I think last thing I'd highlight, I mean, we have a great relationship with the concurrent teams kind of across the country. So, you guys have obviously worked with us not only on this, but, across kind of our fund lineup, and use this as a resource because so much of kind of programs like this, it's around just having the right information to make investment decisions. And so, if you guys are thinking about a opportunity to sell a property, reach out to us, and we're here as a resource to kind of help and facilitate that process.
Yeah, and I can echo that. Your entire team up there has been fantastic partners to us down here at the Well Stewards. And I think my big takeaway listening to this is that this is really something that's very accessible to a lot of people. A lot of people are thinking if these strategies, well, they might only be appropriate for, again, tens of millions of dollars, and that's really not the case. I mean, that leap credit investor, $250,000 greater coming in there, that's not a very big leap to make. And in order to defer as many of these taxes as you can, get potential liquidity, get the step up down the road, get away from the hassles of what ownership look like. I think there's a ton of real plus sides here, at least to considering this. If you're sitting on a piece of property out here that may no longer serve you, and there's a lot of us in Arizona that are certainly in that position. So, guys, really appreciate your time today. A ton of information. I know I'm going to take some time myself to digest it all, and really appreciate you carving out a big chunk of your afternoon. And appreciate it. Thank you.
Thanks, Brent. Thanks,
Thanks for
everybody.
having us.
Thank you.
Have a good afternoon.
Thanks, everyone.